Everyone expected China to retaliate after the U.S. imposed new tariffs on Chinese goods. Washington assumed the usual response would be aimed at key industries like technology, finance, or manufacturing. Instead, China surprised everyone by launching a direct strike at one of the most powerful and vulnerable sectors of the U.S. economy, agriculture. Why is this such a big deal? Agriculture is far more than just another industry in the U.S. It's one of the pillars that holds up the country's global economic power. The United States exports over $150 billion in agricultural products annually, and China has long been one of its largest and most reliable customers. For decades, American farmers have relied on Chinese demand for products like soybeans, corn, beef, pork, and many other agricultural goods. But with this new move, China is threatening to close that door entirely. This isn't just about the financial losses. This is a well-calculated form of economic pressure. China isn't just targeting the U.S. economy broadly. It's hitting the very heart of rural America, home to many of President Trump's core supporters. If farmers begin to feel the pain of lost exports and shrinking profits, that's when political pressure starts to shift. And China knows this all too well. The political fallout could be huge, especially with an election coming up. But the real question is whether this is just the beginning of a broader, long-term strategy. Could this be the first move in a massive economic war that the U.S. is ill-prepared to win? To understand the gravity of the situation, it's important to grasp the power of American agriculture. The U.S. doesn't just feed its own people, it's a global food supplier. Over 20% of all American-grown crops and meats are sold abroad, with China being one of its largest buyers. In fact, China has long been one of the U.S.'s biggest and most reliable trading partners for agricultural goods. But now, with China pulling back from American imports, that reliable market is at risk of disappearing, and that's a major blow to the U.S. economy. Let's take soybeans as a prime example. The U.S. exports tens of millions of tons of soybeans to China each year, and China is the top importer of U.S. soybeans. If that market suddenly vanishes, it's not just about losing profits for U.S. farmers. It's about losing an entire market, a market that has taken years to cultivate. Once crops like soybeans are harvested, they cannot be kept indefinitely. Without a buyer, the crops will pile up and prices will crash, leading to huge financial losses for farmers. If China cuts off American imports of agricultural goods entirely, it will cause massive supply imbalances, and the results will be felt immediately. But China's approach isn't just about causing short-term damage. This is part of a much bigger strategy to weaken one of America's most powerful trade weapons. Over the years, China has worked hard to secure alternative suppliers to reduce its reliance on U.S. agriculture. Brazil and Argentina are stepping in to fill the void left by U.S. agricultural products, while Russia is ramping up corn exports to China. China's strategy now is clear. It has diversified its sources of key agricultural goods like soybeans, corn, and pork. This shift makes it far less reliant on the U.S. than it was in previous trade wars. What's worse for the U.S. is that once China fully transitions to these new suppliers, it's unlikely those contracts will simply return to the U.S. For American farmers, this represents a dire situation. Once China stops buying U.S. crops, there's no quick fix. These farmers can't just replant or shift to a new crop. They're left with an oversupply of products they can't sell. The longer this trade dispute drags on, the harder it will be for U.S. farmers to recover. And it's not just those farmers who will suffer. The ripple effects will extend throughout the entire agricultural supply chain, from processing plants to storage facilities, transportation companies, and local economies that depend on agricultural exports. If this situation drags on long enough, entire rural communities could be devastated. Unlike industries like tech or automotive manufacturing, agriculture can't simply pivot when its markets disappear. In tech, companies can diversify production, find new markets, or adapt to new demands. Automakers can redesign models, lower margins, or look for new buyers. But farmers? They can't just pause the growing season. Crops are planted and harvested according to strict seasonal schedules. If China cuts off demand, it creates an immediate crisis. The farmers can't stop planting the crops. but they won't have a market for them once the harvest comes in. That's where things get complicated. If crops don't get sold, they go to waste, and the farmer doesn't just lose the profit for one season, they lose the entire market for their goods. And here's the kicker. Once China stops buying American agricultural products, it's not just about those products being left unsold for a few months. The entire U.S. agricultural industry could face permanent changes. When Brazil, Argentina, and Russia step in to replace the U.S. exports, they are not just temporary players in the market. They are locking in long-term contracts. If China becomes comfortable with these new suppliers, it's unlikely they will return to the U.S. for their agricultural imports, even if a trade deal is reached. This would leave the U.S. agriculture sector permanently weakened, unable to recover the market share it once held. The true danger of this situation lies in the sheer scope of the damage. A decline in agricultural exports wouldn't just hurt the farmers themselves, it would send shockwaves throughout the entire U.S. economy. Commodity prices across the board would drop, even for products that China never imported. This would affect not just exporters, but also the entire agricultural supply chain, from producers to processors, transporters, and even small-town economies. Entire industries could be forced to scale back or close down, leaving many without work. Rural communities that have long relied on agricultural exports would see their livelihoods disappear overnight. But this isn't just about agriculture. China's move could have much broader implications, especially if it expands to other key sectors of the U.S. economy. Energy exports, for instance, could be the next target. China still imports significant amounts of liquefied natural gas, LNG, and crude oil from the U.S. If China cuts off energy imports as well, it could have a devastating impact on the U.S. energy sector. Similarly, the aerospace industry, led by companies like Boeing, relies heavily on Chinese buyers. If China starts scaling back its purchases of U.S. aircraft, it could send ripples through the entire aerospace supply chain. Then there's the tech industry. The U.S. is still a major supplier of high-end machinery, semiconductors, and tech components to China. If China starts cutting back on those imports, U.S. tech companies will begin to feel the pressure. Whether it's smartphones, computers, or industrial machinery, the U.S. has long been a leader in advanced technology. Losing that market could be disastrous for U.S. tech companies, who may struggle to find new buyers or diversify their production lines. The real question here is, how far is China willing to push this? If agriculture isn't enough to force Washington to reconsider its stance, China still has plenty of leverage in other sectors. The U.S. could lose not just its agricultural markets, but also critical energy, aerospace, and tech markets as well. But China, too, faces risks. Although it has found new suppliers for many of its agricultural needs, it still faces food security issues. If something goes wrong in Brazil, Argentina, or Russia, China could find itself scrambling for food supplies. The global agricultural market is unpredictable, and food security is a key concern for any nation. What happens if China finds itself facing a food crisis while it distances itself from U.S. imports? What if bad harvests or supply chain disruptions lead to a rise in prices? China's new reliance on other countries could come back to haunt it. While Brazil and Argentina are important players in global agriculture, they aren't always reliable. A poor harvest or logistical disruptions could expose China's vulnerability. The situation also puts China in a precarious position in the larger context of global trade dynamics. If China continues to escalate this conflict, it could risk alienating other major global economies, who might start siding with the U.S. This would be a dangerous game for China, as it could turn what is already a trade dispute into a broader, global economic battle. As China continues its strategy of cutting off U.S. agricultural imports and securing new long-term deals with countries like Brazil, Argentina, and Russia, the U.S. risks losing its leverage in future global trade negotiations. The U.S. could find itself unable to recover lost markets, and it may find it harder to regain influence in international trade forums. What's unfolding right now isn't just a short-term trade war. It's the start of a profound shift in the global supply chain that could redefine who controls the world's markets in the coming decades. So what's next? Will the U.S. double down on its trade war with China, Or will China escalate even further? If China fully replaces U.S. agriculture, will Washington adjust its strategy, or will it continue to push forward, risking permanent damage to its agricultural sector? Could the trade dispute spill over into other industries like tech, energy, or finance? The stakes are higher than ever. China has made its move, and the U.S. is not backing down. This isn't just a battle over tariffs anymore. It's a contest for control over global supply chains and the future of the world economy.